doing DeFi, greatest in the world, and they finally about to see why. What you know about XRD? I'm smart money, I ain't never on a decline. What you know about NFTs? It's not just Ace, when you finally gonna realize you need scalability, need more utility, then you better call on these guys. I'm going radical, I'm going Radix, I'm going radical, I'm going Radix. Hyperspeed DeFi, never on a decline, building the future, I feel like a savage.
Hello and welcome. I am Piers and Cyrille, CEO of RDX Works, a core developer of the decentralized finance protocol Radix, a public ledger entirely focused on bringing DeFi to the mainstream. This is our podcast, the DeFi Download, a show about decentralized finance and all things crypto, where we dive into the details of the projects, assets, and services that are powering the DeFi revolution. Today, I have Cyrille Pastro, co-founder of Swaap. Swaap is an automated market maker that is engineered to protect liquidity providers by responding dynamically to the market. Cyrille, thank you so much for coming on the show.
Thank you so much for hosting me here today. Very excited.
No, you're very welcome. And I think that we've probably talked longer at the introduction, as in me and you before the show, than I've talked with many of our guests, which sort of talks a bit to how interesting and complicated what you're doing is. And I think we can start instead of diving into directly what Swaap is, but I think we should start with describing a little bit about what the problem space that Swaap is looking to solve first. So let's start with this idea of the difference. And you said this to me right at the start of the show. You were like, I don't think that we're a decentralized exchange. I think we're an automated market maker, right? So let's talk about the difference between exchanges and market makers and help people understand a little bit about why those two things do need to be separated when people are thinking about what it is to be a liquidity provider versus what it is to be a user within the DeFi space.
Sure. I think this is a very interesting question, and that's one of the main theses that we had at Swaap since the beginning. So essentially, we think that the market is going to split and should be split between what we call exchange layers and liquidity layers or market makers. So essentially, what's an exchange layer? It's a place where people can trade assets. So it's a platform that's optimized to give traders the best price and the functionalities that they want. And what's a liquidity layer? It's a layer that's designed to operate capital in an optimal way for liquidity providers. So the equivalence of both layers in centralized finance, for the exchange layers, you have Binance, Coinbase, Kraken, for instance. For the liquidity layers, you have actors like Wintermute, like Jump Trading, for instance. And the problem, we think, is that it's not possible to operate efficiently for both traders and liquidity providers at the same time, or at least it has never been done so, because they fundamentally have interests that are divergent. So when you're a liquidity provider, what you want is to maximize your revenue. So if you can charge, you want to charge as much as you can to the traders, right? And when you're a trader, what you want is the best price. So you want LPs to provide you with zero cost or even like negative cost swaps, right?
Right.
Which is actually what's happening on AMMs these days when you look into this. Because we have lots of arbitrage that's actually LPs offering free money to swappers.
Right. So like if I have a Uniswap trade, so on Uniswap V2, I can have a trade where, like let's say that the current price of Ethereum is $1,000, and and on Uniswap V2, someone comes along and an inexperienced trader just does a big buy on Uniswap and moves the price of Ethereum such that it's now at $110, $1,010 per ETH. You're now in a situation where there's essentially there's free money there. Someone can come along and move. If the price is still at $1,000 on other exchanges, I can just come along and move that price, and that's essentially that I take $10 for every trade that I do at that price. That is completely risk free to me.
Exactly. And that's actually one of the issues, is that So this doesn't happen only when there's like inexperienced traders that's swapping. It also happens just when the price moves. So when the price moves, the problem is that AMMs like UniV3 or other AMMs, they're blind to the outside world, so they don't know what's happening. So they don't adjust their price, and then you have free money that's hanging for the arbitrageurs. And the problem is that those arbitrageurs, the swaps that they do, they would not exist if there was not this free money opportunity. So it's not like this, this improves trading execution. It actually doesn't improve like the liquidity on the market. It just gives free money to some people that just happen to be faster than others.
Yeah, but I mean, it comes down to the sort of all-important question of market making, which is what is the price? Like that, someone has to make the price somewhere, right? As in, there has to be, like, if I'm saying if I start with a Uniswap v2 pool on Uniswap, and I have ETH on one side, I have a token I've just created on one side and USDC on the other, and there's no other markets in the world. When that market price moves, that is the market price, right? There is no external reference, which is why Uniswap v2 has been so good at bootstrapping things, because when you don't know what the price is, the price has to be made somewhere and it always has to be available to be taken, right? Whereas market makers will pull out of positions and move the order book. So what we're talking about here, just again, I think to separate out again, I think we should be talking about like mature markets where there is a many venues for exchange, where external information is important because you can tell the difference between an inefficiency and a real market movement, and immature markets where those two things are essentially the same thing, right? Like, as in, it is unknown whether or not those are the same thing, because you only have one venue for exchange. You don't have multiple venues for exchange.
Exactly. Exactly. I think maybe the only caveat that I would add is, like, it's never efficient to be doing both the price discovery and market making at the same time, unless you have like more information than everyone. Because essentially in a mature market, what's performing price discovery is just a market. It's like on the, like, when you're looking at an order book exchange, like, no one is doing the price discovery. It just happens, right? Because people are posting orders, and you can just see that on chain. And so when you want to be a market maker and provide liquidity to the market, you just need to look at the price to adjust the liquidity you're providing. And in AMMs, what's happening is that people are doing both market making and price discovery. And for small markets that you want to bootstrap, it makes sense, because the cost of paying for because this has a cost to both do a price discovery and provide liquidity, and the cost is lower than the benefits. But for mature market, there is no need for that. So that's the main issue.
Okay, so right now what we have is this issue that, as a liquidity provider on a DEX like Uniswap v2 or Uniswap v3, let's stick with Uniswap v2 for the moment. So as a liquidity on Uniswap v2, I can constantly have my I will constantly be behind the information curve, because as a passive provider, as the markets move, I will constantly be taking I'll be behind the information curve. The markets move, and then arbitrageurs come along and they move my price. But the moving of my price is risk-free to them. They take the risk-free profit, and I essentially take a loss for doing that. And as a liquidity provider, I have no way of, at the moment, in Uniswap v2 and to a large extent in Uniswap v3. In Uniswap v3, theoretically, I can rebalance myself. Like, Uniswap v3 concentrated liquidity allows me to reconstruct an order book. I can say, okay, well, I'm going to, provide my liquidity between these bips, and then if the market moves, then I'll move my liquidity and rebalance it in the next position. And so I can avoid, theoretically, through like programmatic application of liquidity in Uniswap v3, I can avoid a lot of the issues that come, but I have to be running an active strategy. And really, for Uniswap v3, that boils down to having to be a relatively sophisticated actor, right?
Exactly. So, as you mentioned, essentially, AMMs, what we see is that when you're a passive liquidity provider on AMMs, on average, it's actually a bit like you're playing the casino. It's exactly the same structure of returns. So you have negative net returns, sorry, with very high risk, which means that you have some chances to make a lot of money, but even higher chances to lose a lot of money. And this is due to two factors. The first one that you mentioned is like the lack of information. AMMs are blind to the outside world. And as such, when you're an LP, a passive LP into an AMM, you're always trading against people that have more information than you. And in financial markets, unfortunately, when you have such approach, you're guaranteed to lose, essentially. And the other aspect is like the math that is used by traditional AMMs is the constant product formula. While the constant product formula is good to bootstrap markets, it's simple, it's efficient, it's simple and it works to bootstrap markets, as you previously said. It's not efficient at all to maximize the risk-adjusted returns of LPs. And there are many models that are much more efficient to do this, to perform this function of market making. It has been a field of research over the past 50 years in traditional finance. And there are lots of things to be taken into account and adapted to the specificities of DeFi in order to maximize the risk-adjusted returns of liquidity providers. And that's what we're doing at Swaap, essentially.
Okay, so let's get on to this, but let's basically just round out this concept of like you have decentralized, you have exchange venues, and you have market makers. And the exchange venues are the ones in which people come along and ask for a price, right? They go along and they say, hey, I want to swap token X for token Y. And those are the exchange venues. They're the ones that ultimately say it's going to cost you this if you want to swap this much token X for token Y. And then you have the market makers who are the providers of liquidity on the other side. I think most people often think of financial markets. Even today, I think most people think of like exchanges as matching buyers and sellers, where the buyers and the sellers are essentially the same people, like as in they are like both traders or they're whatever. Whereas actually, normally what you have is you have buyers and sellers, and both are facing off against sophisticated participants in the market who are providing the liquidity to the market, bip to bip or second to second to make sure that there's always some market there available to be taken by either buyers or sellers of a particular asset for another asset. So you have these venues for exchanges and then you have the market makers. And really, to be successful as a market maker, you need to be constantly moving your position as to what you're willing to, what price you're willing to give and what fees you're willing to give and how much slippage you're willing to give and how much depth you're willing to give to a particular market moment to moment. And that should be taking in as much information from the external world as possible, because that market is not going to be the only market. And really the job of a good market maker is working out at the point in which a buyer or a seller comes onto the market and says, hey, I want this thing, is working out how much they should be charging that person, how much liquidity they should be providing, and then how they should be offsetting that risk. Is that a good summary of what a good market maker should be doing?
That's an excellent summary. So to sum up, essentially, like to reformulate in another way, it's like you have a first point, which is having the information as fast as you can. A second point, which is around like understanding risk and pricing this risk. And the last point, which is around like having the necessary liquidity to capture as much trades as you can that are profitable for the liquidity.
Right. Okay. And so now we come to Swaap. So what does Swaap do, and how does it differ from everything else?
Yeah, so I mean, if you look at the market making space today in crypto, you essentially have two types of actors. You have what we call centralized actors, and you have AMMs. So centralized actors, those include the likes of Wintermute, Jump Trading, but also some more infamous players. Alameda Research, for instance, which was the market maker of FTX. Three Arrows Capital, which is a market maker that collapsed in 2022. In TradFi, an infamous market maker is also Bernard Madoff, for instance. So essentially, centralized market makers usually tend to deliver good performances for their LPs because they're also funds. So it's possible to LP there. The issues that are associated with them is that first, they're not accessible to anyone. It's not possible, as a small individual to deposit a few $100 there and benefit from their strategies. You have to be high net worth individual or an institution. Second, they are not transparent. So it's not possible to verify that they are actually performing as they indicate, that they take the level of risk that they advertise, and that they are not using your assets to pay the people that are exiting, essentially. So you cannot really check what they're doing with your money, which can lead to brutal collapses and contagion effects. The third problem is that they keep the custody of your assets. So when there is an issue, you cannot have access back to your funds. So automated market makers are great products which essentially solve all of the problems that I mentioned. They also have additional features which are amazing, like composability within DeFi, which I think is going to be one of the killer features in DeFi and what's going to make the system move towards DeFi. But they introduce a new problem, is that they are not performant for LPs. They don't provide good risk-adjusted performance to LPs on average. So what we want to do with Swaap is to kind of make the best of both worlds. So bring you the transparency, the accessibility, the non-custodial aspect, and the interoperability, but with performance that are worthy of centralized actors. So basically, we do that by essentially addressing the two main issues of AMMs on which we touched upon a bit a while ago. So first one, which is the math. So instead of using the constant product formula, which is, as I said, not the most adapted way to address market making for LPs, we use essentially models that are coming from TradFi, which are stochastic calculation-based models. And we worked with researchers and mathematicians in market making to adapt those models to the specificities of DeFi. So both in terms of infrastructure, also in terms of benchmarks. So in DeFi, we want to outperform HODL, for instance. So that's the first point. And then the second point is around information. So as you mentioned, essentially one of the big issues of AMMs is that they're always dragging behind information, and that leaks a ton of value, which is transferred from LPs to arbitrageurs. Mm-hmm. And so at Swaap, what we do is that we are using external price information. So in short, we look at what happens on Binance, Coinbase, and decentralized venues as well, in order to understand what's the price of the market is, and that avoids a huge amount of arbitrage volume, which turns into better returns for LPs.
Okay, so to sort of read this back to you, you are taking the view that it has been a incredible good in decentralized finance that you could have the concept of a passive LP. That by democratizing the ability to provide liquidity to markets and allowing that liquidity to be composable between different DeFi building blocks, we have created, with what looks to traditional finance often like toys, some incredible building blocks. Because now you can say, okay, there are assets that people are holding, they want to hold. But while they're holding them, they can gain an additional return. And they can do that without needing any extra market expertise. That was the Uniswap V2, sort of promise. Hey, come along. You're already invested in this project. Call it Project X. Let's not call it Project X. Elon Musk will come after us. Project Y. Call it Project Y, right? So you're already holding Y tokens. Now you can also make an extra return on those. This is the promise. That was the promise of DeFi Summer. You can now make a return on those by just providing them passively to Uniswap v2. However, the way in which you provided liquidity was essentially a naive way, a way in which the actual sophisticated market actors would constantly be able to take advantage from, because you had no way of adjusting your position based on market information. You were either the full curve or nothing. What Swaap has come along and said, hey, we don't think that we believe in that democratization. We believe in the idea that there should be the ability to provide passive liquidity based on assets that you hold. However, there needs to be some sophisticated layer in between that allows you to manage your position of the assets you hold to avoid being screwed over by market information which is actually already public. It's not that you're trying to predict what the price is going to do. It's that you're actually able to look at the market and see what the price has already done and respond in a way that means that you don't leak value constantly to arbitrageurs. Now, the key question that everyone is going to be asking is at this point is going to be, well, what is that sophisticated layer? Surely that sophisticated layer requires lots of off-ledger stuff, because that market information often isn't available on ledger. And if you're doing stochastic modeling, that sounds like that's either going to be very expensive from a gas point of view, or you're going to need to be doing the calculations off ledger in some way. So can you talk a little bit about that?
Yeah, that's exactly. I think that's a great summary, and that's also a great question. So actually, Swaap has been live for more than a year now. We deployed the first version of the protocol a year ago, and that version was a fully on-chain model. So we had a triple with BTC, ETH, and USDC, which was live on Polygon. And essentially, this version was based also on stochastic model. The goal was to reduce as much as possible impermanent loss. And it was a success because we had less than 0.1% of impermanent loss in over a year, while on traditional AMM, this number can range from 0% if you are very lucky and the price reverted back to your normal price, to up to 30% a year in the most extreme price movements. So yeah, we were very happy with that. However, we realized that there were issues associated with having the full, everything on chain. The first issue was oracles. We needed super fast oracles, and such oracles today they're only available on Polygon. Polygon had the fastest oracles of all EVM compatible chains, and on Ethereum it would not be fast enough to be able to deliver good performances. The second problem was around the gas, as you mentioned. It's costly to execute heavy gas computations on chain. So I think we were something like 3x more expensive than Uniswap, for instance. It's not a big issue on Polygon, but if you go on other chains, it's of course much more problematic. And the last thing was actually it's super hard to integrate complex on-chain models for aggregators. So you remember the thesis of okay, there are the exchange layers and the market making layers. If you want to be on the exchange layers, you need to be integrated, and it's a process that takes a bit of time. And so for the 1inch, Paraswap, 0x, and now Uniswap X to integrate us, we need to have something which is easy to integrate. And so 2 weeks ago, actually, we decided to launch Swaap v2, which is a new iteration in terms of infrastructure, which actually aims to be more flexible and have an infrastructure which is able to deliver better performance than Swaap v1, while still keeping a trust minimized model and a transparent model. So how does this work? essentially, we have an infrastructure which is hybrid, which is composed of both non-chain infrastructure and an off-chain infrastructure. So first, you have a module which is forked on Balancer V2, which is what we call the vault. This is essentially the main contract that tells how assets are handled. So when you deposit liquidity, how the pools are managed, that routes throughout the protocol the trades, that executes the swaps. So the big advantage of using Balancer V2 is that it has been live for 2 years now with $1 billion in TVL. It has been audited by Trail of Bits, Consensus Diligence, and Open Zeppelin. So it's something that's, I mean, of course, the zero risk doesn't exist in DeFi, but it's rather safe on the smart contract side. The risk is, I mean, we don't know, but of course, but it's actually safer than than a new protocol, at least. So then what we do is that we have an off-chain module that actually operates the quotation system. So what we call the quotation system is essentially when someone wants to make a swap, we have to tell him, okay, how much you're going to pay. And that includes like the mid price, which is the price without fees, and then the fee that we're going to charge, which is here to provide yield for the LPs and manage their risk. So since our models are very complex, it's better to operate them off-chain. And also by getting price information from off-chain, we're able to actually have information that comes 100x faster than it comes on-chain on Polygon. So it gives lots of performance improvements. The problem with such approach is that it's not trustless anymore. For instance, what could happen is that a hacker could hack the off-chain part and then say, okay, now the ETH, for instance, if you have an ETH USDC pool, the hacker could say, okay, now ETH is worth, I quote ETH at 1 cent of USDC, and I buy the whole pool. So in order to prevent that, what we're doing is that we introduce another module, which is on-chain as well, and which is essentially designed to protect LPs and giving trust, enabling them to have enabling the protocol to have a trust minimized environment. So essentially, each time that a swap is performed, the quotation that is provided by the off-chain module is going to be checked by the on-chain verification module. So for instance, we're going to compare the quote against an oracle. So today we're using Chainlink, for instance, to verify that the quote is not too far from the oracle price. We also have more advanced checks that are a bit more technical. One of them is a check that we call the max drawdown. Essentially, it's a check that verifies that computes the performance of the pool post-trade based on the reserves post-trade and the chaining price. And it compares the performance against hodl from the last 24 hours. And if the performance simulated post-trade falls below 4%, the trade cannot go through and is reverted. So there are lots of protection mechanisms that are interesting for LPs and that keep like a model that tries to strike a balance between performance and flexibility and trust minimization.
So essentially you have the swap protocol, which I provide liquidity to, and then you have a algorithm in between which when it sees trade requests coming in via DEX venues, like 1inch or something like that, it then goes, okay, based on all of the information that I have and the amount of liquidity I have available and what I think the price and the slippage and the fee should be, I'm going to essentially provide this as available to the exchange venue to take. So it is a maker, but it is a constantly sophisticated maker that is deciding on a per swap basis what pricing it's going to be giving to the market. And then that is then executed in a way that has guardrails to ensure that even if your system was hacked, the maximum amount of damage would be limited. And I actually don't think this is a unusual setup. Like a lot of people don't realize, but 1inch runs all of its sort of matching algorithms, its routing algorithms off ledger, and IDEX, which was sort of like a really early innovator in the decentralized exchange space. Also, similarly, matching algorithms run off Ledger. Your deposit and your withdrawal was on Ledger, and there was a bunch of checks and balances. I don't think this model is unusual. It's just a little harder for people to get their heads around the trust assumptions of this. But you're essentially saying, look, if you already have these assets and you want to get a return on them and you don't want to get screwed by impermanent loss, putting your money in Swaap is a very good way of doing that, because that's what the algorithm is all about, making sure doesn't happen. And it even has an explicit check to make sure that your returns versus hodl are always strictly higher than just hodling.
Yeah, exactly. So the checks are more designed to prevent extreme events. But essentially, the models are optimized to outperform hodl. So if you are willing to expose yourself to market making, but you don't have like the technicity to do it, which is, it's a very technical job. Like, we're working with 3 mathematicians that come from TradFi. We have PhDs in our company to calibrate the models. Like, it's very technical and it requires a lot of work. And so what we want is just abstract this complexity and make it available for everyone to be able to have access to these products, which in TradFi, honestly, are just for high net worth individuals and large institutions.
Okay. Really cool. So what's coming up on your roadmap? What's next? What should people be excited about now that Swaap v2 is out?
Yeah, so on our end, right now it's about integrating within DeFi. So, when you release a product in DeFi, it's just the first step, right? Because the core value proposition of DeFi is to be like this giant Lego. So it's about integrating with the other pieces, and so that's what we're focusing on right now. So primarily integrating with the aggregators. So right now we're integrated with Paraswap. But we're working on integrating with other aggregators. And once we're integrated with all the aggregators, we're going to be able to see actually what's like the size of the returns that we're able to deliver for LPs. Then it's about like also integrating with other protocols to be able to have composability on our pools, and also like partnerships. So we're working with a few DAOs that are already interested in our offering. So, for instance, we're working with Frax. We have a proposal that has been passed on Frax to incentivize a future ETH Frax pool that will be deployed on Swaap. And essentially, one of the very interesting use cases that we enable is for DAOs to create liquidity against volatile assets. So more for large scale DAOs, because we focus on markets that are quite mature. But essentially, for instance, today, if you want to do a swap on-chain Frax to ETH, you need to go Frax to USDT and then USDT to ETH. And so you incur additional fees and additional gas. And thanks to Swaap, you can do this directly, because LPs are in a better position than in other AMMs to provide liquidity on such asset pairs. So that's one of so we want to push more of those partnerships to grow the use of the protocol and the liquidity.
Awesome. Well, Cyrille, it was really wonderful to have you on the show. If people want to find out more, then they need to go to swap.finance, which is SWAAP.finance. It's got 2 A's in there, swap with 2 A's. What would you suggest where do you suggest people get started? On Ethereum or on Polygon?
I think it just depends on which chain you're most active on, right? If you have a smaller size portfolio, I think Polygon makes more sense, because you're not going to have to pay for high gas fees. If you have a larger portfolio, probably Ethereum is going to be more adapted.
Awesome. Okay, well, thank you so much for coming on the show, and I look forward to seeing some future updates on swap.finance with integrations with aggregators very soon.
Yeah, thank you so much for your time. Really appreciated the conversation.
Need more utility, then you better call on these guys. I'm going radical, I'm going Radix, I'm going radical, I'm going Radix. Hyperspeed DeFi, never on a decline. Building the future, I feel like a savage.